Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Welcome to our latest episode of Colliers Talks. I'm Adam Jacobs, and I'm the head of research for Colliers Canada. I always like to focus on the fundamentals driving commercial real estate, demographics, the macro environment, and the global economy. So I'm very happy to be joined by someone from RBC Economics. I'm joined by Claire Fan. She joined RBC in 2019 as an economist, and she focuses on the macroeconomic outlook for Canada, for North America, and she's responsible for projecting a number of these key indicators we all focus on, like GDP and inflation. She has a number of publications, including the Inflation Watch series and analysis of the labor market and macro trends. Claire, thanks so much for being with us today.
Thank you for having me.
Okay, I want to ask about a couple of your publications recently. You put out your weekly preview yesterday. Opening line, Canada's economic growth is showing more signs of losing steam. Can you elaborate? Where's the weakness? Is it a region? Is it a sector? Is it all the way across the board?
Yeah, that's a great question. So the preview, or the weekly preview that we did, was mostly focusing on the GDP numbers coming out this Friday. And that, in a way, really sets sort of the context for where we expect the Bank of Canada to be heading to in their basically rate announcement in a week. So in the broader sort of macro backdrop, just for context, we are seeing more signs of softening in the economy, and that's starting from labor markets. You know, we're seeing unemployment rate actually increasing by as much as 0.5% over a 3-month period. So that was basically from April to July. We rarely see that amount of increase in the unemployment rate, let's say, without the economy hitting a recession in previous cycles. And outside of their GDP growth for June actually looks set to contract by 0.2%. And what's more important here is really the fact that, you know, the decline is pretty broad-based across sectors. So we saw manufacturing activities, wholesale sales, retail sales. So all of these things started to decline simultaneously in June. So I think that's really, you know, more of a concerning trend, more so that, you know, we're seeing one specific sector showing some weaknesses. It's like a very broad-based sort of slowdown that we're starting to see. Mind you, is only 1 month worth of data. It's only for June, but still it puts the end of Q2 into sort of a weaker sort of position as to where we're heading into in Q3 as well. So the key question here is really, you know, is that sort of weakening momentum, or is that softening expected to be extended into the third quarter, and what can we expect from there forward?
Okay, that's wonderful. A lot to chew on there: rates, job market, consumer spending. So many questions. And let me ask one more. You touched on consumer spending, which is, I guess, still growing. You noted that there's been a shift from goods to more services. Is this a temporary correction from lockdown, from COVID? We all bought porch furniture and now we don't need to buy it anymore. Or is this more of are you guys looking at this as a permanent shift in the economy? People want out of home entertainment, they want restaurants, they want travel, or is this just kind of a overcorrection?
In terms of the trends that we've been seeing in consumer spending, you know, this shift from goods consumption to services consumption, that's something that's long been anticipated, because you did have something short of 2 years of consumers or households simply not being able to consume services. You know, these things include travel, or going out to restaurants, simple things like that. So there is a certain amount of pent-up demand that's really driving the shift that we were seeing. So I think what's more surprising is really how strong or how long this pent-up demand has been holding on for. So, you know, the interest rate started to increase in March of 2022. So that was well over a year ago, and it's seen incredibly rapid increases to date. And what's surprising is, you know, households just seem largely, you know, unharmed by higher interest rates. And that also speaks to the spending trends that you've talked about, right? Good spending are coming down, but they've never been soft during the pandemic period, because for a period that was all that households could spend their money on. But so it's not really surprising that we're seeing more of a flagging, like you said, how many home plans do you really need, or that sort of stuff. But it is the spending on services that's been quite resilient. And that's really a key surprise factor, I think, to a lot of economists in terms of just this tighter monetary policy framework or situation that we are basically in the middle of, and how strong spending still is.
Yes, and I had a follow-up question there. This is unfair, and I hate when people do this to me, but I dug up an article from RBC Economics,
Of course.
from 13 months ago,
Of course.
saying in July 2022, this is it. The recession's here. It's right around the corner. But you're saying only just now are we starting to see the very first decline. So it just takes time for people to adjust their expectations, for the rate hikes to have an impact. People didn't believe it at first, because I often say to people, it feels like we've been having this discussion about the recession is coming next week, next month. We've been having that for years, ever since the rate hikes began.
I think that's a great question. And, in part, many of us have tried really hard to almost, go backwards and explain what's driving this resilient trend in consumer spending that we've seen to date. And I think number one, to point out, there are sectors or spots in the economy where we're already seeing some softening, or a bit more significant softening from rate hikes, and that's the housing market. What that spoke to me was essentially, households on a broader sense are doing fine, actually. So, the increase in interest rates due to whatever reason, it could be that the delay from just how mortgages work, because obviously if you have a 5-year fixed rate mortgage, higher interest rate doesn't really impact you until your mortgage hits renewal. And you might see more immediate impact if you're a variable mortgage holder. So it might be some of that dynamics working out. It might be, again, just the excess savings. I think north of 300 billion now that we're speaking about. So it's a huge amount of savings that the households are still currently holding on to. It might be both of those things. It might be other factors as well. So whatever the reason might be is really, really sort of, supported, again, just the spending trends that we've seen today.
Yeah, I think it's been a huge surprise. I mean, as soon as the rate hikes began, we said, this is it. This is Armageddon. And we're on our 10th rate hike and maybe one more to come, or a few more. Now, you also had a podcast recently. This is a good jumping off point, where you explored my favorite question, which is, are rate hikes even doing anything? As we're discussing, they're supposed to radically reconfigure the economy and the job market and inflation. Sort of, not really having the intended effect. So I think everyone has been surprised at the resilience in the job market, consumer spending, even housing. Okay, it's down. It was supposed to be down 50 or 60%. Maybe it's down 8 or 10%. What's different about rate hikes this time? We have a model for how they're supposed to work, for how they have worked. Why isn't it having that effect?
Well, its broader impact can be probably seen from two things. Number one is just broader aggregate demand, which we talked about a lot already. I named a few things that could potentially, so we all know monetary policy tend to work with the right? It takes time, again, to really filter through, to slow household and businesses spending and investment activity with usually a 4-quarter lag. That's usually how long it takes for tighter monetary policy to start working. But this time around, it has been, again, more than 4 quarters, and we're starting to finally see some first signs of weakening in the economy, and there are a lot of reasons. So on the spending end, we talk about excess savings, we talk about pent-up demand already. So these are all things that could be, just working in some sense against tighter monetary policy and shielding or insulating households from the tighter, monetary rates environment that we're seeing today. And also on the labor market as well is also where, for the businesses, normally, obviously, with rates inching higher, we do expect a lot of them. It's just becoming harder for businesses as well to service their current finance obligations, making debt payments and that sort of stuff. So we should see some slowing, and which then translates to less hiring demand, which are, again, we're finally seeing right now. But it did take longer for businesses as well. And that has to do with sort of the more structural labor shortage issue that we've been talking about for decades. With population continuing to age, we are, starting to see more the impact of essentially baby boomers, retiring out of the labor force. And these positions are usually, more senior or experienced than those that are entering into the labor force. So these are big shoes to fill in a sense. So what that impact really had on businesses were that for the longest time, they really had problems with hiring. And this is not one sector. This is like businesses across different sector. So we've seen there's a ratio of unemployment to job vacancy, and that's basically suggesting for every single sector that we're talking about manufacturing, we're talking about wholesale, retail, and most pronounced in healthcare and constructions. So these are the two sectors that are facing disproportionately more acute labor shortage issues, but nonetheless, it's really broad-based. And, so that's been working against sort of the tighter monetary policy. Businesses, in a sense, don't want to let go of workers, even when they anticipate their sales to not be doing so well in the coming quarters, right? So there's being like, we had so much issue or challenges with hiring workers, we don't want to let them go. So that, in a way, has been supporting labor market condition as well. So it's just some of the factors that are really, giving that push and pull against or towards monetary policy that we've seen today.
Yeah, lot to discuss there. And I definitely want to get to the demographic point as well. And what you're saying, we've certainly heard from clients, which is, okay, yes, rates and inflation, but workers have received a raise during that time. Like the household, one of the reasons the household is resilient is that the job market is tight and raises have been happening and people are making more than they were in 2019. Let me stay on rate hikes for one moment. Given what you're saying, okay, rate hikes are having their effect eventually. So that's it. We don't need to raise rates anymore. Or do we need to stay the course? Do we need to continue raising rates? We've already had 10 rate hikes. There's potentially another one next week. If it's taking a while, but it is having the intended effect, then do we need to raise rates again and again and again? Or have we sort of reached the right point with it? Again, this is an opinion, not maybe a little less data, a little more opinion. So,
but then, that's exactly the question that the Bank of Canada is pondering, right? Have we done enough? Are we there yet? And I don't think, maybe they do, but to be honest, I don't think they know fully. As the same with all of us, right? At this point, we can make sort of reasonable suggestions when it comes to, just how soft the broader economic backdrop will become. And we are, again, starting to see softening in labor market. But sadly, from the Bank of Canada's perspective, what they're most concerned about at this point is still inflation and inflation trends, especially those that are suggested by the few core CPI index that the Bank of Canada tends to pay a lot of attention to. So these core measures, if I have to explain them in simple terms, they're essentially sort of calculated to get a better gauge at underlying price pressure that's like basically driven by broader domestic demand. So forget about food, forget about energy, forget about mortgage interest costs. These are all things that you can name and pinpoint, right? So what about everything else collectively that's more, as a sort of a sign of how broadly consumer demand is really holding up to, and what that does to prices. So that's what the core measures are constructed for, essentially. And those core measures have not been doing so great. So they've been stuck at around 3.5% to 4% annualized rate on a 3-month annualized basis since October of 2022. So they've been dropping pretty rapidly before that, but since then they've been stuck. And the risk really here is the longer that they get stuck at those levels, the longer households and businesses are going to start to expect inflation rates at that level. So that's a key risk for the Bank of Canada. They can't afford to have inflation expectations become unanchored. So I think that's really in their head, the question to be answering, what's the 11th rate hike going to do on top of the previous 10, right? To be honest, it's really in the near term, the impact will really be more of a signaling. From the bank's perspective, they're saying, we're still willing to step in if we think there's more work to do. We are not done with the inflation fight. If price pressure continues to be more persistent, we will hike. So that's sort of the message that they want to give us. So it's really their credibility that they're trying to hold on to at this point. And the more material impact from that 11th rate hike will probably come a year later. We talk about the lag already, right? So that's sort of the way that we've been interpreting.
Yeah, it's interesting how much is tied to just the expectations of we have our expectations. They need to change our expectations with their policy, be credible. Okay, and I know you write regularly about inflation and sort of not just the headline number, but picking apart, okay, food versus gas versus housing. But like, I think this is a question a lot of us and our clients which is, why is inflation so persistent? Like the story of there aren't ships coming out of Taiwan or ships are stuck abroad. Like that's not the story right now. I don't think it's not about the supply chain is messed up because of lockdowns abroad or something like that. So inflation is persistent because we think it's persistent, or I think there's a little more to it than that, right? Like what exactly is keeping some of these things so high? Like, okay, mortgages, I think we understand what's happening there. A little less so in these other areas. Can you elaborate on that?
Yeah. So again, it kind of goes back to those core measures that I touch on just now, which are so basically the run up of inflation, or the brief history of high inflation in Canada post pandemic. Is really a lot of questions were thrown at us basically at the beginning of the run up of inflation. It's like, do you think this is demand driven or supply driven, right? Is it the global supply chain challenges or issues that's behind the inflation trend, or is it like because demand is just so overwhelmingly above where they were pre-pandemic? And at the time, our answer, the answer to that question, we think, is both. So you do have like incredibly high demand, specifically for goods, during the 2 years when services weren't available to be consumed. That basically bumping against a lot of the logistics issue, container getting stuck somewhere on sea, and then other issues as well, the chip shortage, to name a few, that's still in a way hindering auto production even as we speak. So a lot of those issues combined and really, worked up to be the high inflation that we're seeing today. And it really takes both demand and supply to cool for inflation to come down. And so far, we've seen a lot of progress being made on the supply side. A lot of the shipping indicators and costs associated with international container shipping have been coming down closer to levels pre-pandemic, but it is the demand side. Again, it goes back to the surprise that we've all been talking about, just how incredibly resilient consumer spending has been and not on goods anymore. So again, this goes back to spending on services. To date, it really is, some of these like prices associated with key services that are at time discretionary. So again, things like hotels, accommodation when you're traveling, and local restaurants. So these things are predominantly supporting the inflation trends that we're seeing today, which is also why the US Fed and the Bank of Canada, they both have a measure called Supercore, which is essentially services CPI excluding the shelter component, because like you said, the shelter component gets biased either way by monetary policy. So excluding that, so that super core measure, are not basically showing a good sign. And what that's really telling us is, domestic demand is simply still too strong.
Interesting. So much discussion of rates. Let me shift gears a little bit to like demographics. This is a fave topic of mine. There's been a lot of headlines, record high population growth in Canada, which is generally favorable. And you've mentioned, okay, aging population, wave of retirement, need for employees, but we're also seeing some of the challenges related to that. Like a growing population means we need growing infrastructure, we need healthcare and education and housing to accommodate that. So where do you come down on like we're at a real peak in terms of population growth? Is that what's the balance of that in terms of benefits and costs, and where do you see that going?
So yeah, we've definitely seen some pretty record increase in population in 2022 because of higher immigration target. And it's not only driven by higher immigration inflow, it's also driven by higher non-permanent residents. So that include people on their work visa and their student visa as well. So that's obviously by far the biggest driver of population growth. So on the good side, I think we're all aware of like just how, having immigrant inflow can really add to the economy because it adds to aggregate demand for different goods and services that's being offered. And obviously that then downstream lead to more job creation as well, more hiring and more investment because you need to basically service a demand that's now bigger than they were before. So that's sort of the good side. And back to the labor shortage issues that we've been talking about as well, that's like so pronounced across different sectors. So very interestingly, so for basically the first couple of months of 2023, we've seen record increase in the unemployment, in the total employment number. Because that's mostly driven by population growth. So what that's saying, the story that's telling is basically you have this record inflow into the labor force, but they're getting absorbed extremely quickly. So that really goes to speak about how at least partially the labor inflow driven by population has been helping in a big way to solve the Canadian labor shortage issue. But then obviously, like you said, that there are constraints as well when it comes to, just integrating and making sure that, they have like adequate housing. So housing, obviously, when it comes to challenges with growing population is the elephant in the room. It is, a huge challenge, but what I like to say about that is it's not a new challenge. In a way, if you look at the data, it's actually very interesting. The immigrants and non-permanent immigrants are actually much more likely to live in unsuitable homes. So these are homes that do not actually have enough bedrooms to house everyone. So, and they're also more likely to rent. But regardless of that distinction, whether they're renting or they're buying, they nonetheless add to overall housing demand, and that could drive prices up over the longer run. So I think that's where a lot of concerns are when it comes to just like, can we really house the added population that's expected to continue to be the case for the next couple of years. And the second one is also when it comes to just how we can really incorporate them, it's like sufficiently or efficiently into the workspace. So we've actually put our report on underutilization of immigrant skills. We measure that by, how likely are they to work for a position that doesn't require the same level of training or education attainment that they are. And they're much more likely, essentially. So that speaks to just a lot of challenges when it comes to recognizing their skills. And number one, that's basically we're not recognizing their credentials when they're trained not in Canada. So that's a huge barrier to be broken. And it's a double-edged sword, right? Because for the immigrants, they're not earning the income that they're anticipating to, that's, sort of corresponding to their education attainment, be it not in Canada or not. And at the same time, we have a labor force that's a lot less productive than what it could have been if we were to utilize their skills more efficiently. So both of these things, what's really, I think, important to recognize here is, it's just the issue itself is not growing population. It's, in a way that the gap in labor market outcome actually stems from structural challenges. So these are challenges that have been long-standing before the population started to increase more rapidly in 2022. And they will be here even if we, were to tap the brakes a little bit on the immigrant flow. So it's really more like, how do we work to address this issue deep down to the roots instead of, curbing the flow of immigrant where these problems are oftentimes more exacerbated in.
Yeah, I agree. And it's one of those problems where when you zoom out globally, like many people would be happy to have this problem. When we look at your Japan or Italy and their problem is the population is going to shrink by 50% in the next couple decades, a lot of them say, oh, your problem is too much growth and too many people want to live in your cities. Perhaps that's not, it's still a challenge, but it's a challenge some countries would like to have where Canada is
it's a
kind
good
of
problem to have.
Yeah,
yes.
kind of in some ways. Now you mentioned like productivity. It's kind of a hot topic. We hear about productivity is low. It hasn't grown. The United States has such higher productivity. It's been flat for decades, whatever. So you alluded to one point here, which is, okay, there's capacity for perhaps productivity to be higher than it is, but is this a huge issue? Is it it's of great interest to economists, to those of us in real estate or other industries, like where does productivity fit into this? Is this a big concern we should have?
Well, it has been a big concern. I think it's a common problem that's actually faced by, well, comparing to the United States, we're not doing as good, but more broadly speaking, productivity growth in a lot of advanced economies have been slowing for decades. And there are a lot of, potential explanation for that. One being, just slower adoption of available technology was like a common sort of reason that people usually give behind slower productivity growth. But more specifically to Canada, you usually get growth to productivity from two sources, right? Number one, from the labor input. So that goes back to the point that we were talking about earlier, the more efficiently you can utilize the immigrant skill, the more unlikely it is for a trained doctor to work as a Uber driver, versus as an actual doctor, the more productive the labor force will be, right? And the issue is obviously more constrained, especially when we need people in healthcare and skills trade as well. So kind of like two sectors that new immigrants are historically underrepresented in when it comes to the workforce. And then the second part of where you can add some productivity is obviously through capital deepening. So that's basically through, more business investment into, R&D and that sort of stuff. So OECD report, interesting, I just found out about this myself when I was doing research for this podcast. Canada is ranked as the most attractive country for startup founders among all OECD countries. So with high scores in all dimensions, so that includes regulatory framework for starting and closing a business, access to capital, market conditions, reach for international trade. So we're like obviously very trade reliant, and that's in a way opportunity as well. So what that's saying is we're pretty good at starting businesses, but apparently we're not very good at growing them. So Canada does have a much smaller size when it comes to the average size of businesses. So we have a much larger proportion of small businesses, SMEs in Canada. So that's been linked to, just the stagnating sort of growth and productivity that we've seen over the past decade, partially because smaller businesses are less capital intensive to begin with. And what that does is basically, it's because capital is in a way more expensive to these smaller businesses. So they're more labor heavy, and then that creates bigger financial constraints and higher fixed costs when it comes to implementing things that are efficiency enhancing, including, ICTs, or what they're called information and communication technologies, and labor training, and investing in R&D again. So all these activities tend to, just be more pronounced or more accessible, I would say, in a way to larger businesses as opposed to SMEs. So that in a way have been part of the reason a lot of people explain why there's a productivity gap between US and Canada.
Interesting. Great discussion. Just a couple more questions. So I feel like we just have to touch on this and everything. The cost of housing.
Yes.
I mean, we've kind of talked around that. We've talked about rates. We've talked about population growth. We've talked about migration. Housing costs are very high.
Yes.
People can't afford to own a home. Like, does this keep you up at night? Like, what needs to be done to ease this other than let's cut rates back to zero? Like, leaving that off the table, housing it's a benefit for many people, what's happened, but it's a problem sort of big picture wise for the economy. If people can't afford to live here, if all of their money is spent on rent, like what needs to happen on the housing to kind of restore balance?
Yeah, so that's the question that policymakers are trying to solve these days, how to solve the housing crisis. And a lot of talking points have long been discussed about, like, when it comes to removing barriers to new building activities. Number one, let's say to allow for permit issuance to come through a lot faster. Again, like OECD actually ranked Canada as the 34th among 35 OECD countries when it comes to obtaining a permit for a new general construction project. So we actually, the US by comparison ranks number 3, or 168 days faster than Canada to obtain a permit. So that in a way just speaks to the amount of barriers when it comes to, just getting some of the new construction and permits online, not even to start building, but just putting them into the pipeline. So Obviously, that's one thing to address. The other thing is also, how do we fit the demand that's incoming a bit better in terms of housing? So again, we kind of know that newcomers or immigrants to Canada tend to rent among the first years when they come rather than outright like buying houses and owning houses. So, including we're building more suitable rental options, especially for families. So we do see a lot of rental units, obviously downtown, right? Like in high density areas. But, so comes down to addressing the missing middle issue more so, building available rental units in neighborhoods close to schools and other amenities that could be lower on density. So where, demand in that sort of space, which is essentially renter households living in single and semi-detached homes, have actually boomed over the past 10 years. So they increased by 33%. So the demand is there, right? Obviously, as to demand for housings in many other forms, but especially as more millennials probably growing to the age of, forming families and starting to look at some of the options if they can't afford to buy. So I think it's, addressing obviously the some of the barriers, but at the same time, adding to the supply pool in a more strategic way, obviously is the sort of the key here when it comes to addressing the housing. But that's just my 2 cents, and not a housing specialist, but it is an issue that deeply concerns me personally because I just can't see the prospect of me being a homeowner like ever. But hopefully that changes, and through some of these ways that potentially the government and on all different level can combine and work to address some of these issues too.
I think we're all hoping for that. Let me throw you one last question, which is like, what's one indicator you're watching that we haven't discussed? Like car sales, tech jobs, export volumes. Like we've talked about rates, and we've talked about inflation and housing and demographics. Like, what's something that you as an economist have your eye on that we might not be aware of?
So it was actually, the immediate answer that came to my mind is this job switching rate that's published by StatCan. It's not publicly available. It was actually, the Globe did an article on it yesterday, which is why I remember it today. Very short memory span. But then basically what it measures, so I think that the key question that we are pondering, given the weakening labor market data that we've seen today, is like, is this a head fake, right? Like, is this just volatility? Are things actually slowing down more significantly? Is this like preluding a broader slowdown in hiring demand? Or is this just like 3 months of slowdown? We see like the unemployment rate bounce right down or go back right down. So, and then in a way, that job switching rate, which has been declining quite drastically. So it's basically speaking to the fact that the unemployment rate could increase. Well, sorry, let me backstep a little bit. The unemployment rate could increase from two factors, right? Number one, people are actually losing jobs. Number two, you have more people entering the labor force that can't find jobs. And those are very different prospects, right? So we know the second factor is true because we have a record surge of population adding to the labor force. So if it's just taking them a bit longer to find jobs, that's not super concerning. But if people are outright seeing layoffs, that speaks more to the weakening trend. I mean, like either way, labor demand is slowing, but it's just like, is it something that's persistent that we can expect to foreshadow probably a mild recession that we are still anticipating in the Canadian economy? And again, the job switching rate, that's been coming way down just in a way because you would only switch job if you're really confident in the economy, let's say, and when there are a lot of opportunities flowing around. So that sort of speaks to the liquidity of hiring as well, where labor free flowing, which tends to freeze up when things are, going downhill. So just something that's popping into my head. But then again, it's not published on StatCan's website. So if listeners are interested, you can email StatCan and they'll give it to you because I've done that before. So yeah, that's one of the indicators that, just like more focus on the sort of pressing current issues in this current economic cycle that I'm watching.
And that's all the time we have for this episode of Colliers Talks. A very special thank you to our guest, Claire Fan from RBC Economics. It's been a pleasure discussing these topics around the Canadian economy. And thank you to our audience who joined us from wherever you access your podcasts, and we'll see you again soon.
Thanks for listening to Colliers Talks podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.